Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Axel Merk of Merk Investments. How you doing today, Axel?
Great to be with you.
You know, I was thinking in my head, I was like, it's Axel, not Alex. It's Axel, not Alex, right?
Well, those old enough may recall Axel Foley in Beverly Hills Cop that was Eddie Murphy playing in the 80s. And actually there was a sequel out, but he doesn't curse as much anymore. So he's not quite as fun as he was in the 80s. So that's how people remember my name.
Yeah, exactly. Axel Foley. So I want to start with today's news. Alan Greenspan passed away. 100 years old. Many people contribute to the low interest rate policy, quantitative easing. Well, quantitative easing was newer, but they pretty much contribute this easy money policy to Alan Greenspan kind of being one of those pioneers coming out of the 80s after Volcker and such. And so just want to get your thoughts on, like, you know, his contributions to the financial markets as we know it today.
Well, they are very much have his signature all over the place. It was Greenspan that got inflation down to 2%. Volcker, who gets all the credit, actually didn't get it down all the way to 2%. He obviously did the most crucial thing to set that in motion. Greenspan warned about irrational exuberance, telling all of us that, hey, yeah, we can find a bubble, but market timing is kind of difficult. He was known for the Greenspan put, and that's haunted us ever since. The one place where I give him maybe undue credit, he gets a lot of bashing for missing the financial crisis. I was one of the few who warned about it. I personally liquidated my stock portfolio in late 2007, and so I was one of the ones warning. So I certainly saw the warning signs. Most people did not. And the defense I have for the Fed is not so much a defense of the Fed, but a criticism that people took too much emphasis on the Fed. And one thing that the Fed didn't have, they didn't have the financials of the GSEs. The other thing that's Fannie and Freddie, the other thing that most people missed, including the folks at the Fed, is that in 2004, there was an instruction by the Department of Urban Development to lower the lending standards of the GSEs. So you had these extremely levered institutions. And by the way, this is not a partisan thing. Bill Clinton had the third way to give credit to low-income people. But then George W. Bush, he tried to make credit available to everybody because he thought that was the road to riches. And so there were efforts underway to lower lending standards, and that really set us up for disaster. Now, Greenspan missed it, and he should take blame for that. But I think that the real tragedy is that in the aftermath and during the financial crisis, we learned all the wrong lessons. Rather than dismantling the GSEs, we doubled down on regulations and made things ever more complicated. A side effect of it, by the way, is that these IPOs, like the recent SpaceX IPOs, and I'm not giving financial advice on any specific company, happen with a decade delay. And the wealth that's generated by the markets is shared by a few venture capitalists rather than the masses at large. And so it's a very complicated legacy. Greenspan, by the way, was a magnet. When he was in the meeting room, people crowded around him. When he and Bernanke were in the meeting room, they were around Greenspan and not Bernanke, just to put a little contrast there.
Yeah, that's interesting for sure. So we had some a recent Fed meeting with Kevin Warsh. I think this was his first Fed meeting and such. What was your takeaways from that?
I've been rooting for Kevin. I've gotten to know him over the years. I followed all his speeches, or most of his speeches over the years. He had been criticizing a lot of the things about the Fed that I'd been criticizing about. And so people were poking fun at all the task forces he created. But put yourself into the shoes of somebody who comes into a politically charged environment, wants to change a institution where lots of egos, where he isn't even the boss of many of the Fed presidents. They're highly independent. So he says the unthinkable, we're going to get price stability, right? Of course, everybody agrees to that. And he makes a point by shortening the statement, by taking out the quote unquote forward guidance. And then everything else he says, okay, I'm going to take care of this later. And so I think he did about as well as he could. I just want to make a few remarks. The forward guidance, and he mentioned as much, and I'm trying to paraphrase it, is so harmful because the Fed is taking away its own gauges. It's like a dog chasing its own tail when you give forward guidance. When you don't give forward guidance, and by the way, forward guidance was first introduced by Volcker, but really introduced in earnest by Bernanke and in the aftermath of the financial crisis. But when you don't give financial forward guidance, the market will read the data. And the advantage of that is that the Federal Reserve can look at the market. When you take that away, and many other things that have contributed to that at the Fed since the financial crisis, you end up with this debating club that reads the tea leaves like everybody else. And the fact that we're stepping away from that is fantastic. The long end of the yield curve, by the way, the yields came down, which is a sign that Warsh achieved what he wanted to achieve. He has a lot of work cut out for himself. I wish him all the best. And the reason I wish him all the best is because it matters. The Federal Reserve sets the benchmark for what is, by regulation at least, considered the risk-free rate. All asset prices price around that. A lot of the things he's going to do, we'd worry about interest rates being up or down a little bit. The market dictates most of that. But what he can do, he can change things behind the scenes. The reason the Fed got politicized is because the Fed has stepped onto political turf. We need to remember that monetary policy is about setting interest rates, about money supply. It is not about allocating credit to the economy. And during the financial crisis, the Fed started buying mortgage-backed securities. That is allocating money to the mortgage sector. No wonder that politicians then interfere with the Fed, because they have a say. And then, of course, during the pandemic, they started giving loans to businesses. So the Fed needs to get out of many of these businesses. And Kevin Warsh is on board with that. And so that's why I'm rooting for him.
Okay. So what do you think about interest rates? I mean, obviously the yields were creeping up, especially during the start of the conflict happened with Iran and the U.S. I mean, typically gold sells off when yields go up. I mean, because gold doesn't pay a yield, so some people may ditch gold for bonds or whatnot. And so just curious in your thoughts on interest rates.
Sure. Let me give you maybe from a year ago and then now why gold last year surged and this year was so correlated to what's happening in Iran. A year ago, you may remember we introduced tariffs. When you introduce tariffs, you're not just impeding the flow of goods, you're impeding the flow of currency. Less money was coming in that pushed up borrowing costs. And instead of cutting our deficits, the administration increased pressure on the Fed. And so in that environment, gold thrived. The Iran war, a very different scenario. First of all, heading into it, speculators had come back into gold. Speculators used to be in the gold mining stocks, then went to meme stocks, but then a year and a half ago or so, they were attracted by miners and gold again. And so there was some leverage there. That was one of the reasons there were headwinds. But then, as you point out on interest rates, the Iran war caused rates to rise, notably long-term rates to rise, bonds to sell off. But the war in Iran has been priced as a shock rather than a structural change, which means inflation expectations didn't change. Long-term inflation expectations. And any gold buck worth their salt will tell you that it is impossible to predict long-term inflation. That doesn't mean there aren't market-based measures, the long-term TIPS yield, for example, that give you the long-term inflation expectations. And so what's happening when bonds sell off, but long-term inflation expectations don't change, real long-term yields are rising. And ultimately, this BRIC, this barbaric relic, right, competes with the purchasing power of the currency. And so if in the long run, on a relative basis, you get compensated more, at least as priced into the market, then the price of gold goes down. This happened to be correlated with how equity markets reacted, right? And so that's why people said, oh my God, gold is correlated with equities. And as most people know, but we need to remind ourselves once in a while, is The long-term correlation of the price of gold to equities is zero, but it doesn't mean it's always uncorrelated. These correlations are morphing in and out. And so looking forward, what we should focus on is when is that correlation with the price of oil breaking down, then we are moving on to the next phase.
So when you're looking at the gold price measured in dollars and you're looking at inflation and such, many gold bugs, I mean, they view inflation from the M2 money supply. People are looking at the Fed pivoting on quantitative tightening to some version of quantitative easing. They're not calling it that. How do you make sense of all that?
Well, yeah, let's talk about that a little bit, because Kevin Warsh, in the run-up to becoming Fed chair, said, yeah, we got to shrink the balance sheet. And people were scratching their head. How is he going to do it? He's going to blow up things because, for context, after the financial crisis or during the financial crisis, the Federal Reserve shifted to what's called an ample reserve regime. People can always get credit. Balance sheet is going to grow. And then obviously there was QE on top of it. One of the challenges in reducing the balance sheet is that there are contradictory regulations affecting financial institutions. Nobody really knows what balance sheet the Fed needs to have. And so one of the things that was in the Fed statement was the ample reserve regime is going to be untouched for the time being, kind of give the market a sign that we're not going to kind of throw a wrench into the financial system, so stay calm. But then one of the task force mandates is to review the ample reserve regime. And that is a clue, I think, that was completely undercovered by the media. Basically, he wants to get rid of the ample reserve regime. And who knows what's going to be next? Going to the pre-financial crisis regime is, in my view, the right thing, where the New York Fed was intervening in the markets to channel the federal funds rate. There you can keep a minimal balance sheet. And the idea is a huge balance sheet pushes up asset prices. So in a K-shaped economy makes the wealth disparity worse. And so if you have a smaller balance sheet, you can keep low interest rates, which are much better for everybody. The question is what's going to happen. The folks at the New York Fed, when I have talked to folks there, they love the ample reserve regime. And the reason they love it is because they can just set an interest rates and go play golf all day. Whereas in the old system, every day it was stressful because you needed to make sure everything is working out that day. The huge advantage of that system is that when something goes wrong, you see where the trouble spots are. In the ample reserve regime, you don't know where there's a problem in the financial system. When you don't have an ample reserve regime, you can see when something goes wrong somewhere, and then you can dig deeper. And so it gives you many more signals. I happen to think it's worth it. What happens out at the end of the day, I don't know, but we're going to see changes to how the balance sheet is managed. It may take a while to get that done, but that's one of the things that Kevin Warsh has on his agenda, and it appears to be high on his agenda.
Okay, got it. Thank you for sharing that. So gold, what's your outlook on gold with these current macro headwinds?
So just for context, for those who don't know me, we manage about $4 billion in gold and gold miners. I personally have substantial gold and miner holdings. And so I'm talking with that hat on just to provide that full disclosure. And so I have been always a long-term investor in gold. The environment that's hostile to gold is the higher for longer environment that we were in after the Federal Reserve realized that they messed up and had kind of the aftermath of financial repression, keeping real interest rates artificially high. If we were to go into that environment, I might be concerned. And by the way, part of the reason the junior miners did poorly in that environment is because even though most of the junior miners don't have debt, it does give quote unquote credit risk because the financial conditions are tight, funding conditions are tight in that sort of environment. Warsh believes in the productivity boom. I don't want to put words into his mouth, but I understand he believes that the only way out of this huge debt mess that we have is through growth. You need to outgrow it, make debt as a percentage of GDP less. So while he is genetically hawkish, if I may say that, he would only impose this sort of higher for longer environment if it were an absolute necessity, but otherwise give the market benefit of the doubt. And then at the other end of the spectrum, of course, we have a Congress that has absolutely no incentive, it appears, to be financially restrained. And so in that environment, I'm quite comfortable with my gold holdings. That said, yes, the headwinds that were caused by the Iran war, they were real. And so there was a correction in the price of gold that was quite appropriate in that context.
Okay. So the United States has close to 40 trillion in debt, huge deficits, huge costs with interest expense. So there's two schools of thought that I've been kind of diving into. One is that the United States has to inflate the debt away by printing more money. And another is that the United States would potentially default on this debt. And so
what's the difference? That's the same scenario.
Yeah. One is more blatant. One is one is a little more stealthy, right? So, just interested in your thoughts on that.
Yes. So, first of all, the absolute level of anything is a very bad predictor of timing, and so I don't want to downplay the 40 trillion in debt. But balance sheet items tell you very little about prices. They don't allow you to quote unquote trade on that. And part of the reason I say that, if the Eurozone debt crisis taught us anything, it is that policymakers are amazing can kickers. They can push the problem down the road, right? We often hear that, oh my God, this is going to happen and everything is going to blow up. Policymakers, as we learned in the financial crisis, can change the rules of the game as well. So let's keep that in mind. But to your question, the main thing about having very high levels of debt is that the incentives of government and those of savers are not aligned. So don't expect the government to preserve your purchasing power. Don't expect they to do something that will help you. And especially, and that's a message to my beloved gold bugs, don't expect the government to reintroduce a gold standard. That's not in their interest. In order to have a gold standard, you need to have your fiscal house in order. That's not going to happen. Have your own personal gold standard if that's what you like to have. And yes, the government is going to get you because they're going to tax you. But that's the world we live in, right? And so both sides of the political aisle appear to have very little incentive these days to get the long-term entitlement issues in order. And by the way, when the Social Security Trust Fund runs out, if I understand it correctly, the executive has power to prioritize payment. And so we'll get means testing on Social Security and the like. Right? There will always be a day tomorrow. We think about these red lines and something is going to happen. This cliff is going to happen. Well, look at Latin American economies. They've had many cliffs and there's always a day after. There is the main thing that happens when the can is pushed down the road. People will think that they got cheated. Plenty of people think they got cheated, rightfully so, during the financial crisis and this and that. And what happens as a result is that people elect more populist politicians, both on the left and on the right, right? The debt burden we have got us Donald Trump, for example, right? I mean, there is a direct relationship there that when we can coast along, we can deal with things, but the next turn might be a hard move to the left, right? Because people will look for solutions and the populists will have a message. They're not going to fix the substance of it. And so once you're eroding many of the basics, and I mentioned Paul Volcker earlier today, one of the things Paul Volcker had is if you want to have a thriving society, you need to have sound fiscal policy, sound monetary policy, and sound institutions. Now, Volcker was actually a big government guy, so I don't agree with everything that he has said, but he's right on principle on these issues. And so when these things start to erode, we are going to elect more populist politicians, and it is very, very difficult to get back on the right path. It's one of the reasons why I'm so thrilled about Kevin Warsh being at the Fed, because at least he has the right mindset on many of these things. Now, ultimately, fiscal policy, monetary policy is hostage to fiscal policy. I'd like to remind people of Mario Draghi's whatever it takes thing, right? Ultimately, if you have bad fiscal policy, there's only so much you can do with monetary policy.
Yeah. Yeah, it seems like they're going to destroy some stuff, or they're, I mean, as far as like the politicians, I mean, especially the more populist they are, you know, they're going to cater to their constituents, and they're going to continue to,
what's going to keep you in business, right? So that's, and just to maybe expand on that one, everybody has learned that since the pandemic, at least. When you're faced with a supply shock, the economically right thing to do is usually political suicide. And so actually one of the interesting things in the Iran war was that there have been some moves by politicians that weren't productive, but nothing on a truly massive scale, right? I mean, in the oil shock, we had price controls, writing checks to consumers in the pandemic. And yes, European countries, Asian countries played a little bit with price fixing and the like. And politicians started saying, okay, we got to write checks to the folks so that they can pay more, that they have more money. If you have limited supply, giving people a break, so to speak, while that's politically the right thing to do, is just going to create more shortages. But there's a reason the price is high, because we don't have enough of that stuff. But politicians, of course, ought to do something, and having a laissez-faire attitude is not going to get you reelected.
Okay, so I'm looking at the price of gold now, and what I'm seeing is that it is trading below its 200 moving day average. And I'm curious, in your outlook on the short, medium term, and long term on the price of gold. And so do you think this is a buying opportunity? Do you think gold could head lower? Just curious in your thoughts there.
Well, I don't have a crystal ball about what the price of gold is going to do tomorrow. I sold a tiny bit of my gold holdings late last year when the nomination of Kevin Warsh became clear, because all else equal, that would be a headwind. But I have more than most, if not all, of your listeners in terms of gold and gold miners in my personal holdings. And I believe that we have an administration that really wants to double down on economic growth. We have a midterm election coming up. And so we're going to double down on deregulation. We're going to find ways to help boost this economy. And so that's an environment that's very supportive for the price of gold. And as I indicated, right, we don't have any issues that seem to fix the long-term big issues. We have way too much government debt. The government deficits, even though we are in somewhat good times, are way, way too high. And so to me, it's a no-brainer that investors might want to have it. But it's not a risk-free assets in the sense that daily expenses are in US dollars, right? And so the price can move around. My speech is regulated because I work in the industry, so I can't give you a specific price target. Yeah. I have to dance around the topic. But it's what I can do, the value I can offer is I can get people thinking about risks that they may not have thought about. So that's why I'm talking about kind of Kevin Warsh from a little different perspective than you might hear from other viewers. I encourage people to stress test their own views based on that, right? The good news about the miners is, and I know a lot of mining investors on your audience, is that there, especially on the junior end, there are opportunities to invest in miners where you have catalysts beyond the price of gold, that as many of these junior mining companies get developed, there can be disproportionate gains that you can be had as these junior assets get developed and more institutional investors come in. It's one of the things we do in our business to help these small companies grow. And then the higher price of gold is kind of the icing on the cake that you get on top of that. But I'm a long-term investor. published a book in 2009 where I disclosed that I had a college savings plan in physical gold. For many years, the price of college tuition was coming down when priced in gold. And so I'm quite a bit of a long-term investor, and I don't, well, I of course look at the intraday price of gold. I try not to get too distracted by that.
Okay, got it. I mean, and I'm looking at the price of gold back in 2009. You said when that book came out.
Well, the book came out. I started the college savings plan in 2004, so that was pretty decent timing. I quote unquote only had 3 of my 4 children there. My youngest was born in 2007, but that was a pretty decent entry point. And by the way, what I did is I had a spreadsheet that by the time the youngest would be 21, how much gold would I need to put aside each year, so that I could send them to a good college. And spreading it over 21 years, or some of them had been born already over a shorter period, was quite an undertaking. And actually, in the financial crisis, I pre-funded some of that. I decided to make that a priority. Turned out to be a pretty decent investment, and I preferred that over other ways of saving for college. And I had one expensive kid, but I had one who saved me a lot of money. She is a college dropout, did the startup route. And then I have 2 who went to, well, one still is in college. The youngest one is, but the 2 of them are in state school. And so they saved me a lot of money.
That's good. That's good. So I'm looking at just from when the book released in 2008, I mean, if you measured that to the top back in January, I mean, you're looking at over 680%. Even if you go to today's gold prices, that's over 400%.
Outpacing inflation in college prices, yes. And that was kind of the idea.
Yeah, for sure. Yeah, that's amazing. I mean, people could have definitely done well with that. So with the miners, are you looking for more alpha? Are you into any of the big miners? Obviously, I know you can't disclose names, but just generally in the sector, are you looking at more producers, developers, exploration companies?
We like developers and help grow them. A lot of the companies we hold, we start very early. The largest holdings we have that are producers are all we started as when they're very small. We focus on the scarcest resource in that sector, which is good management. Just like in any sector, it's good management teams that are able to execute. They can attract the money for the next phase in the development. They can deal with the local regulations. There are many things that need to take place to develop a mine. And so what we think of ourselves is doing venture capital light, which a lot of the junior miners are public, so that helps. But we sometimes can go in pre-public, pre-IPO. But by investing in several of these companies, or quite a few, not all of them will make it. But the ones that do make it, some of them will make it big. And when there's a funding round to go to the next stage of the development, rather than price going down because there's dilution, often the price pops higher because the market is happy that there's money available for the next round of funding. Larger investors tend to come in future rounds, providing higher valuations. At some point, they may get added to indices and the like. That helps in the valuation. And so we're really looking for these corporate catalysts that go beyond just the price of gold, to find ways to add value to portfolio. And I believe we've done that quite successfully over the years.
Okay. What are your thoughts on silver?
Well, I'm a simpleton, right? Gold is easy because the industrial use is so little. When you go to silver, you have much more industrial use. And that is a good part of the reason why the volatility is so much higher. We have silver exposure, including a large private silver company. One of the big challenges in the silver sector is it's often a byproduct, and there are not many good silver companies. Many of them are not well managed, and so getting that silver exposure is more difficult, and it is, of course, much, much more volatile. And so, historically, by the way, the investor in the precious metals versus the miners, they're often lumped together. I happen to invest in both, but a lot of investors invest in one or the other. Historically, the gold investor is risk averse, even though the price of gold has a volatility around that of the S&P 500 with spikes, as people are reminded of periodically. But the gold miners have always been more volatile. And so the gold miners historically attracts more of a speculator. And so I like the mix of the gold and the gold miners, but the risk profiles are distinctly different. And of course, silver is notoriously volatile, and the silver producers are, of course, with that have quite a substantial volatility. So it's really a question of risk assessment. As a professional investor, I think much more in terms of risk than anything else, because can I afford the risk to have that sort of volatility? And how does that fit into my portfolio allocation? For the individual investor, by the way, I make this, and I don't even think it's a joke, this comparison that the professional investor does risk management, the individual investor panics. It's the same thing. When volatility spikes, the professional investor takes down leverage. Well, when volatility spikes, the retail investor takes down leverage. I mean, the art is, of course, that you do that management before something hits the fan, right? And then you're better off. But it's the same sort of thing, right? You want to think about how much volatility can you bear. And the metric I like to give people to think about is, are you able to sleep at night? Because rather than looking at some numbers that are abstract, if it stresses you out what you got in your portfolio, you know that you got too much of it. And so that, I think, is a much more common sense way of checking whether you are overexposed to a particular sector or a particular company.
Okay. So there is some exposure to silver. What are some of those macro things that you're thinking about to, drive that decision?
Well, let me take that as an opportunity to maybe make a broad point here about the macro environment, because I mentioned the industrial component of silver. In 2011, Mark Andreessen, the venture capitalist, came out with an essay saying that software is eating the world. It was an environment where, with a low barrier to entry, you could develop these amazing software programs with dramatic profit margins. It was timed almost exactly with the top of the precious metals market, where in a sector where capital investments are high, margins were coming down with a gold price that was suffering for a long period, was coming down. Fast forward to today, and AI is eating software. Well, the key difference is that in AI, the barrier to entry is tremendous. Capital investment is huge. The margins, nobody knows what sort of profit margins these AI companies will have. And the reason I mention this is that we live in a world now where we have a much more level playing field, where you can invest in technology or in the industrial sector, and you need to make substantial investments. Very similar to mining, one of the things about precious metals mining is that the margins are very, very healthy. And so one of the things we see is that in mid-sized mining companies, you have generalist portfolio managers participate. That makes a difference because the mining sector is tiny. And to the extent that they allocate money, you can have outsized returns. And so I think this is an exciting area to be in. And of course, all of this is before the administration's efforts to kind of help invest in industrial production and the like, on reshoring and the like. And so all of this gives some exciting opportunities. And but the main thing is that there is a more level playing field. And then at the other end of the spectrum, because we live in an investment world where everything is driven by ETFs, ETFs do not invest in junior mining companies. They don't invest in IPOs. They don't invest in private funding rounds to get warrants and the like. They're technically allowed to do it, by the way, but the ETFs have this mechanism to trade near net asset value, and they use market makers to do that. These market makers want to have an ability to hedge themselves. And so market makers are not very attracted to investment products that are difficult to hedge. One of the hallmarks of the precious metal sector is that it has the greatest dispersion of returns of any S&P sector. Now, it's a fancy way of saying that the returns are all over the place. And you can have very different, if you look at the funds in the precious metals sector, the return profiles are very different. They're not all the same. So active management really matters, and particularly it matters in the precious metals sector. And because a lot of people don't understand the junior mining sector, it provides more opportunity. So I really appreciate that sector.
Yeah. So silver has been produced at a deficit year over year for a while, and we're seeing like more use cases for silver coming to the front. It was placed as a strategic metal on the strategic metals list that Trump administration has put out. You also have this issue with copper and the need for copper in the AI boom and such. And so, are you paying attention to that? Is that modeled in any of your investment thesis?
Sure. I mean, gold, by the way, is also a strategic metal these days. It helps on the permitting on federal grounds. You mentioned copper. The one thing, because you asked me earlier, kind of where we invest, the large producers, they are so large these days that it really doesn't make much of a dent for them to acquire junior companies or mid-sized companies often. So they've gotten involved in these huge copper gold projects where the capital investment is orders of magnitudes larger. But it creates a very, very different risk profile where the returns are sometimes 20 years out. And some of these projects are in jurisdictions that are less than stable, I suppose, and you don't know what's going to happen to your money. Whereas if of course, it takes years, but not 20 years to get your money back. And even in some questionable jurisdictions, at least the return on investment can be quite rapid with some of the, comparatively speaking, anyway. And so it does create, again, more dispersion where the large companies, I mean, Barrick Gold changed its name from Barrick Gold to Barrick, right? I mean, that's just an example of that you need to go broader. And I mentioned earlier, silver's often a byproduct of things. Most miners, they're not gold bugs. They like to dig, right? Whatever they get out of the ground, and then they'll find something. We invested in a gold company in Australia. They found some lithium. Lithium was hip, and so they rebranded themselves as a lithium company. As long as they get to dig, they're happy, right? So we gotta keep that in mind and that's part of the reason why we say we invest in management teams, because extracting the resources off the ground is really in a cost efficient way and profitably, is really the name of the game. And yes, there are pure play gold companies in particular, but yes, if there's other things in the ground, they'll want to get that.
Yeah. Okay. Well, lastly, I want to leave off with your thoughts on this. Central banks continuing to buy gold. We did see some selling pressure from central banks when the U.S.-Iran war started, but recent charts from the World Gold Council show that central banks are back accumulating again. And there was also recent charts showing that gold as the reserve asset has surpassed the U.S. treasuries and such. And so want to get your thoughts on that. Do you see that as a consistent trend? Is that bullish?
Yeah, I mentioned incentives earlier. I have an undergraduate degree in economics, but I'm not a PhD economist. But what I've learned from economists is that follow the money, look at incentives and what drives people. Just like individual investors, don't trust the government to take care of you because their incentives are not aligned. If you're a government that is not friendly to the US, you are quote unquote incentivized to try to distance yourself from the dollar. Now, obviously, that's more difficult than it appears. And just because those central banks want to get out of the dollar doesn't mean they pile all their reserves into gold. But gold is a beneficiary of that trend. And so as long as those incentives remain in place, I think the incentives for those governments, and then of course, if they need the money, they need to spend some of it, right? The gold always goes to where the wealth is. But these incentives matter a great deal. And so then let me make the broader geopolitical point. I have argued that the Ukraine war, the war in Gaza and the like, and obviously now the Iran war, they're just symptoms of a new era. The peaceful period since World War II is over. And so I expect less political stability over the years and to come. And so in that sort of environment, I happen to think that those quote unquote incentives will continue to be around. At the same time, we're all still drunk on growth, right? I mean, the Chinese, they imported much less oil. Well, is it because the economy is going down the drain, or were they able to ramp up coal production or some other things? But ultimately, that regime's primary incentive is to stay in power. So they'll do anything to stay in power, which means they will be willing to destroy the currency should that need to be the case, if they can get some growth out of that, right? And so in that sort of environment, those incentives are firmly in place. I expect those central banks to continue to buy, and keep in mind that central banks are very price insensitive, right? It's very different from the Indian consumer that buys less gold when the price of gold is very high.
Yeah, yeah. Definitely. Well, Axel, I appreciate you for coming on the show and providing us with your thoughts and analysis. That's definitely appreciated. I've been actually catching up on some of your recent interviews and such. And so I encourage the audience to go check those out as well. Where can people follow you, connect with you, ask you questions, or do you have any publications you're putting out?
Merkinvestments.com is our corporate website. I didn't talk about our products, but you can find them there. We have a free newsletter that's available. I'm active on social media at Axel Merk on Twitter, or X these days. Again, I can't talk about products there, but I try to be very accessible. If you have any questions, reach out. I try to respond. When there's a central bank meeting, I tweet a lot about what's happening there. I happen to think that monetary policy is more exciting than a soccer game. So if you can put up with that, I will not tweet about sports. But I have my dog chase a ball, right? I don't know why humans love chasing a ball. So I happen to think I'm the normal one. Everybody else is unusual, but you do with that whatever you think is appropriate.
We definitely have to have you back on, especially as the Fed is continuing to, be under new leadership and maybe heading in a new direction or whatnot. And so appreciate you for coming on the show, Axel.
My pleasure.
And you all be sure to hit the subscribe button if you haven't subscribed yet. Love to have your support. Thank you all for watching.